Our next guest is the chief of one of the biggest streaming companies in the business. David Harquail of Franco-Nevada joins us again. David, so good to have you back on the show.
Good to be back as always.
Well, last time we spoke, you said a lot of interesting things, including the fact that you're the laziest CEO in the industry. But I remember that we focused a lot on exploration or lack thereof. And you said something that I really remember, that investors don't really care about exploration anymore. They're looking for returns. They're looking for value. So 1 year later, David, how do you feel?
Well, things are definitely picking up. You know, I think when I made the remarks last year, it was just in the light that people weren't buying operating companies or exploration companies. They'd rather buy the ETF if they wanted gold exposure and not worry about any of the issues in the industry. And I think what's happening now is you've seen some life in the gold market, but also you're seeing some tailwinds for the whole industry. I just came back from Australia last night, and we have 80 royalties in a lot of the old historic gold belts of Australia. And you can see them now coming to life. And the reason is the Australian gold dollar price is terrific. There's no competition now in terms of for operating inputs or capital inputs. You can build and develop and do exploration much more cheaply than you could in the past. And so a lot of these projects that couldn't cut it when the Aussie dollar was stronger, now they're going to be much more interesting. Same thing is happening in Canada, and you're beginning to see life in some of these camps. We have a royalty at Lakeshore. The Gap 144 looks very good. You've seen Detour now bring in the West Detour. We have a royalty on that. But again, the economics look very good because the local currency and the cost inputs now are favoring the gold industry.
So you're optimistic, David.
Much more optimistic. In fact, I'm disappointed. I'm at this conference right now at the GSA, and I'm actually surprised how I said it was like preaching at church. There's a lot of empty chairs, a lot of gray hair, and everyone's praying still. And they shouldn't be praying. They should be actually out there.
But you would think after this rally, though, that
it hasn't made enough of the front pages yet. Okay. I don't think it's gotten the visibility to bring in the, except the die-hard followers of the industry. Those are the ones that have picked up on it. They're the ones that have changed the share prices so far. But I don't think it's really gotten the attention outside of the normal followers of the industry.
Let's talk Franco-Nevada. You had a lot of big deals on your plate here. Teck Resources, $500 million deal with Glencore. So you seem to have the cash to be able to do these type of deals.
Yeah. We've invested $2 billion in the last 18 months.
So what's next?
I just closed my last deal on Friday for $500 million. And this is classic. I get this from all the investors. It's important we do the technical due diligence and the security and have all the documents right. So I think it takes us 4 months to do a really big deal and do it properly. And I just closed it on Friday, so I want the market not to think we're going to get another one done next week. Give us a bit of time to do it right. But we've done 4 big deals now in the last 18 months. We did Candelaria first. We did Antamina with Teck. We just made our big contribution to Cobre Panama, and now Antapaccay with Glencore. And the market loved the Antapaccay deal.
Some are saying that once gold prices move higher, silver prices move higher, miners will start to feel the pinch of these streaming deals. Some analysts have gone as far to say that streaming is, the new hedging.
Yeah. It's that's a Rob McEwen quote. He's been very anti-streaming and hedging. What we're offering is the cheapest form of capital for a miner. And if you look at a mining company, they have to make a decision. Do they want to do a big equity issue? Do they want to do debt, which is going to risk their company? Or do they want to do a streaming, a royalty deal, which is something in between? And the equation is pretty simple. I think for most of these companies, the amount of the equity they have to issue, say 20 or 30% to get over their mine done, versus giving up a couple percent to a streaming or royalty partner. And I think it's a very interesting discussion because I've talked to certain companies and we've talked about the trade-offs of doing that. And I haven't had one chairman of a company saying, well, it's really not 20 or 30% because I can always dilute that in the future. In other words, you can issue more stock in the future. And the discipline with a royalty or streaming thing is, yes, you're going to pay me 2% on that mine and anything else you find on that property in the future. But if you do 20 or 30% of your company, you're giving up 20 or 30% of everything you have and everything you're going to do in the future. So I know if I were an investor in a company, I'd actually prefer the ones that are doing the streaming and royalty deals because they're actually trying to manage their equity dilution in their companies and not give up too much of their company to future shareholders.
Well, you obviously have a model that's working well for you. Is there a company that you look to and say, I like their model?
In the mining industry itself? I've been on the operating side. I was part of a major operating company for 7 years. And it's a tough business. And when you're running a mine, it's all consuming. And each mine has got its own characteristics. So there's not a lot of scalability in the mining industry because each deposit is different, each jurisdiction is different and has different rules. There's different labor practices in every country. So you have to be really on top of each of these operations to do them well. What I find is, our business is we don't get involved in any of those details. We let the operators run the yellow trucks. And what we do is once we make our investment, it's done. We can't do anything else. We're never going to get another cash call. We just focus on those future investments. As a result, we have a business model that's absolutely scalable and that we can do hundreds of these royalties. We have 262 mining assets right now. We have 47 producing mines. We're doing it with less than 30 people.
How do you manage that?
It gets easier and easier because when you have multiple mines in a camp, your auditor can go cover multiple mines in a day or 2 days, and so he can spread the cost of his trip more efficiently. Our overheads, something I'm proud of, are even lower than when we started 8 years ago. So we're running this company for less than $20 million in G&A. And if you look at it, we're a 10 billion market cap company. That's 20 basis points. We're twice as efficient as the GLD that charges 40 basis points. And I believe we can continue. At 262, I would like to have 1,000 royalties. Maybe I have to add an auditor or two. But I think the power of it is I get my portfolio more diversified. There's less risk from any one asset, that people don't have to worry, oh, this mine is going under care and maintenance, or this mine didn't perform as well as expected, because it all balances out by the ones that work really well. And our job is just to expose ourselves to the better ones in the industry.
All right. David Harquail of Franco-Nevada, it's always a pleasure speaking with you. Thank you so much for stopping by, and thank you for watching our coverage here from Gold Stock Analyst Day. Stay tuned, we'll have more for you.